You're listening to Seattle Real Estate Podcast.
We're going to check out what a couple of national real estate experts are saying about the housing market, because I am hearing rumblings and I am seeing some indications of a little bit of a market slowdown here in the Puget Sound area. We haven't had enough data come out to be able to go, yep, that's a slowdown yet. But just some of the rumors, some of the things that I'm hearing, some of the listings I'm seeing that would have sold a few weeks ago are now sitting on the market just a little bit longer. It's making me think, okay, are we at one of those buyer fatigue points where the market is just like, yeah, we can't do this anymore. We don't want to do this anymore. Or are we at a price point that is so high across so many markets that buyers are like, yeah, we're a little bit resistant to going out and making multiple offers on that? Or are we at one of those seasonal points where it's like, okay, people are focusing on getting the kids through school, got to get summer plans in the works. All right, if we're going to buy a house in summer, let's do that in June, not necessarily at the end of May. Those are all things that are legit points for a slowdown. They happen fairly often, and people are like, oh yeah, stats are down, but we explain it by that, and we don't see it until afterwards. But I think we're on the kind of the front end of something here. And also you got some of the big boys talking about this stuff, and they tend to just talk kind of in general terms. And I'm going to dissect that because I talk on the micro level as well. Because if you don't know me, my name is Sean Reynolds and I own a couple of real estate companies. One is a real estate brokerage and another is a real estate appraisal firm. I'm a real estate guy. I read the news. Let's get into it. All right. Robert Shiller is saying he's from the Case-Shiller Index, and he is a Nobel Prize winning economist. Robert Shiller, home prices will fall and cause some pain. We've got pain and gain. Did you see that movie? Probably not. It was The Rock and Marky Mark from the Funky Bunch, Mark Wahlberg. And that was an epic movie. It was a really good movie. But if you're not into bodybuilding, you probably, or fitness, I should say that, you probably didn't see it. But it was a fun movie nonetheless. Well, we've got cause some pain because house prices are going to drop. And I think we've just had this run for so long that everybody's kind of expecting a slowdown at some point. It can't go up forever. It just can't. It can't. The housing market is hot as home prices continue to rise, but Nobel Prize winning economist Robert Shiller predicts prices will eventually drop. Okay, that's a pretty easy call, right? At some point in time in the next day, the sun is going to rise. Mark my words, that's going to happen. They'll come back down, not overnight, but enough to cause some pain, Shiller told Yahoo Finance Live. What if it was named Yahoo Finance Live? That'd be funny. The latest Standard & Poor CoreLogic Case-Shiller National Home Price Index posted a 13.2% annual gain in March. Okay, that's across the United States. 13.2. That means there's some markets that are just not doing a lot, but there's some markets that are up around 20%. Get that average, 13.2%. Those are enormous numbers, not sustainable. It's the fastest pace prices have risen in more than 15 years. Last week, the National Association of Realtors reported the median existing home price in April was $341,600, up 19.1% from April of 2020. Almost up 20%. That, I'm going to go out on a limb and say, is not sustainable. I mean, these are just numbers that you can't have go on. You need numbers down, 3/4 less than that to be long-term sustainable. And you've got markets where it's going to go sideways on you. It's going to go down. That is just how markets go, right? This is not a market that collapses overnight, Shiller said. It's less short-run volatile than the stock market, but you can see that we're seeing price increases now that haven't quite been realized since those years just before the financial crisis. Okay, so we're talking about the financial crisis and the run-up we had there. Those were some numbers that were incredible, and those are the kind of numbers that we're seeing right now. Huge difference is we are fundamentally way more sound now. And I am not just a real estate guy blowing smoke, you know where. There's all kinds of things within our processes now that that we didn't have in place back in the Great Recession, back in '05, '06, '07. And I lived through those years, both on the appraisal side and on the real estate brokerage side. So I kind of caught it from both ends. And it was the Wild West back then. And a lot of the deals that got financed, I wasn't involved in because I didn't work with subprime lending. That was a genre of lending that I didn't have much to do with because I've always had normal clients on the appraisal side, and my clients on the Summit side didn't need subprime financing. And by subprime, I mean anything, basically hard money. And it was hard money being given out at normal rates. That was the problem. And you didn't have to prove, you had liar loans all day long. You didn't have to prove that you actually had income. Just state what your income is there. It's a stated income loan, literally. Tell us what you made. Okay. And then we have the right to come back and check that out if we want to. And you'll need to be able to prove that with tax returns, but we're not going to ask for that, for that up front. Somehow that was a legit thing. And no wonder we got into troubles, right? We're going to give you a 1-year teaser loan, a 1.99% interest for 1 year. If you can't get squared away in that year, guess what? You're hosed. And if in that year, if you happen to buy that home, '06, '07, '08, guess what? Market went down. You can't refinance. Hosed. I mean, that's why we had so many houses go back to the banks. And the banks are like, oh, man, let's take all these homes back. And so they did. And then they realized, oh, that's not a good call either because we lose money when we do that. We're not in the business of taking back assets and cleaning them up and putting them back on the market. That's not really our gig. So we're going to do it poorly. And that is what's happened. And they lost a lot of money. Too big to fail. Shiller said there is no clean explanation why the housing market is so hot. He expects it to continue another year or two, driven by low interest rates and the COVID-19 pandemic work from home revolution. Okay, so but those things have been going on for a while. I think we have seen basically kind of the full extent of those low interest rates and the COVID-19 pandemic work from home revolution. I think we're going the other way now. I think people are going back to the office. People are like, oh, geez, it was a genius idea to buy this home when there was no traffic. But man, I gotta wade through this traffic 2-3 times a week now. Ooh, we need to reimagine and reassess our decisions that we made at the beginning of the pandemic. That is the narrative I believe you're going to see because people are like, oh man, this traffic is getting bad. So everything that I look at here in Seattle, and Seattle's not a huge city, but it's big enough where you're like, okay, people are back at the gym. People are going back to work. Downtown areas that haven't been rocked by protests and ridiculousness. Those areas, they're getting people back. Big companies are demanding their employees come back, right? We're seeing more and more of that. And the more moratoriums on evictions are going to be lifted. You're going to have that kind of come out, and that's going to rock the housing market. So you've got some stuff going on that we're in the midst of dealing with right now. And the stats haven't said it, and you're certainly not going to see it on major media for a while. But I'm at that point where I'm kind of like keeping my eye out because I've got enough indicators of stuff where it's like, all right, am I seeing shadows where there aren't any? Maybe. That's what an old school real estate guy does, right? But Shiller cautions that people are also driven by narratives and market sentiment. Okay, yeah, kinda. It's a topic he wrote about in his book. All right, here's why we're talking about narratives and market sentiment, because he's going to make some money off of a book he wrote called The Narrative Economics, How Stories Go Viral and Drive Major Economic Events. Maybe I should read that book before I make any comments on it. I probably won't. I don't know. I think it's some kind of irrational exuberance, he said. People are having fun, and they will as long as prices keep going up. I don't know that people are necessarily having fun. Are they having fun? Is maybe a certain segment of the population who is wealthy, are they having fun? Remember at the beginning of the pandemic, who was it? It was some massive CEO or something, and he had the drone shot of his 400-foot yacht, and he was socially distancing in the aisles of wherever. And people are like, hey, the rest of us are stuck in our tiny homes, and you're off partying like a rock star, literally coming off land in your helicopter. That's not really socially isolating. So you have some people that have probably enjoyed the pandemic. But even then, the boats, the big boats, the small ships, the sailboats, they were going into ports and there was nothing open. You couldn't even go into ports. I watch a lot of sailing and a lot of yachting videos because I think they're interesting, and people that go around the world and they do YouTube for a living. They got to grind out some content, but you can make some decent money doing that. But you're never at home. You're on your boat, and it's like, I like to go out my boat, but I also like to go home. It's just me. So we're back to irrational exuberance. Is that really a thing? Maybe. I don't know. Aspects of a bubble. Shiller describes the current housing market as having aspects of a bubble to it. He compares it to the rapid home prices increases seen in the years leading up to the Great Recession, which wiped out trillions of dollars of American family wealth. Well, it was the rapid home prices and then the rapid decline of the housing market, and that triggered everything else, right? That was the trigger, because guess what? The home market was a house of cards at that point. It's wildly different now. It just is. Kind of made sure with a bunch of legislation and a bunch of things that changed. One of the things that, happened in my life is I had built up, call it, 25 years worth of working with clients. That relationship was severed overnight in the appraisal industry. So now my clients had to go through a third party called an appraisal management company, an AMC, and they take a piece of the pie. They take a piece of the appraisal fee and they keep it, and then they send the order on to us. And so that happened. So now I had to go back and sign up with all these appraisal management companies and kiss their rear ends to get the business that I had driven in over the previous 25 years. Wildly unfair, and yet long term, it worked out okay, because now you no longer had clients hitting you directly up for information like, hey, why is this appraisal so low? I need you to bring this appraisal up, which is illegal, by the way, but it happened day in and day out. So now you no longer have any pressure on appraisals. Those mortgage guys got to go through the appraisal management company, and the management company then gives you the information, and then you tell the management company, all right, here's what I did. Problem solved. Issue gets resolved by the management company. So things like that took place. And people have to come up with actual down payments. People actually have to prove on paper they have the income to support the loans that they are getting. Basic things like that have changed. Those are huge differences. Down payment being a big one. You actually got to bring some skin to the game. So if the market goes sideways a little bit, you can still get out. You're going to lose everything, but you're not going to go negative in a short sale or possibly a foreclosure situation. Shiller said today's housing market looks similar to 2003. There is excitement and people are talking, and some people are bidding way more than the asking price, and that becomes a narrative or a story. That's a supply-demand issue. I mean, straight up. It's not, I heard this story about a house. Hey, let's go bid way more than we need to on this because of that narrative. No, but people kind of, I'm going to give them the fact that people know they've probably been through the process enough times. And that's where on the front end as a real estate broker, a managing broker, an owner of a company, I've got brokers that come to me, hey, I got this new buyer and they're not really getting it. They're going to offer just full price, but they got a bunch of contingencies in there and it's not going to work. And I'm like, okay, you probably need to take them through 2 or 3 or 4 offers before they figure out what it's going to take to be competitive in that situation. So it's not the narrative that is there. The narrative is just describing the reality of a super hot market where you've got a ton of people. I described to a listener the other day, it's not that people are shifting from one home to the other and we've got a lack of supply there. We've literally got 13 different buyers bidding on the same home. That's the issue. We don't have enough available homes in our inventory supply. We just flat don't. Some states have more, some states have less. Washington, Seattle, we had historically low levels of inventory going into the Rona crisis. How do you think that worked out? Not well. We've got even less now. We're well under a month. We're more like 2 weeks. All right. So that becomes the narrative or the story. But he tempers his comparison, saying the current housing craze is different from the mortgage crisis that caused the last housing bubble to burst. So it's not the same as 2003, Shiller said. It could be stronger. I think we have better protections. We have better supervision of lenders and appraisers and everybody else in the pipeline. Okay. There's some more governmental oversight. And, at first I was like, F you guys. You guys ruined my livelihood. This sucks. And then it was like, oh, hey, but now we get this. All right, I don't have to deal with that anymore. All right, this. And here's another big thing. The average age of an appraiser, somewhere in the upper 50s, maybe lower 60s. Those guys are retiring in record numbers. And they've made it such that becoming an appraiser is damn near impossible unless you're an appraiser's kid. That's the bottom line. Very hard to get a interim intern type position to get your 2 years here in the state of Washington of basically doing intern as an appraiser. It's really hard to do because they don't provide any incentives for us as the owners of appraisal companies to do that. The minute your intern gets licensed, he can go out on his own, do his own thing. Hey, screw you. Don't need you anymore. Don't need your business anymore. Going to go do my own thing. They've made it so easy to do that there's no incentive. So you got all these old guys running around and they're retiring, and we've got fewer appraisers on the ground, kind of like the police situation, but for totally different reasons. And so guess what? Fees have gone up, turnaround times slower than they could be. Supply and demand, right? So I don't know if we should be worried about 2007, 2008, 2009 happening again. No, but you're going to have some slowdown at some point here, probably pretty shortly. The current run-up in prices, according to Shiller, is disquieting, and he cites Phoenix as an example. Seattle's right behind Phoenix, right? The biggest increase over the last year was Phoenix, and home prices have gone up 20% in 1 year. Seattle's right behind it at 19 and change. Those are not sustainable numbers. And that's what I've said all along. This is kind of like, saying that this is not sustainable is kind of like if you don't have enough police officers covering your city's not going to be safe. That's a pretty easy call. And appreciation in the real estate market at 20%, that's not sustainable. Hard stop, period. I mean, that's not even debatable. You know what I mean? All right. Real estate's going to go up 20% for the next decade. See how that works out. It won't. Shiller points out that demand in the housing market gets all the headlines while supply tries to catch up. Record prices for lumber, he says, are driving up prices for newly built homes. And we've got a crazy situation going on with lumber. Crazy situation. Just not enough. And the lumber mills, they're not bringing in more saws. They're just not. They're like, yeah, the amount of money and time it would take to get that in place, this little shortage thing is going to be over before then. And then we're stuck with, twice the capacity we need. We don't need that infrastructure. So they're basically just, driving up the price of lumber. The builders might be building to profit from these high prices now. Okay, they're going to put the homes out at prices, whatever the market will accept. That's kind of how this works. But it hasn't happened yet, said Shiller, and that has him worried. No, builders they're building to profit from these high prices. That is what they do for a living. So they are doing that. And you know what? It's a business. They got to make money. Can they take advantage of this? Absolutely. And we have seen some price increases on new construction spec stuff that is like, what? And no wonder we can't, on the appraisal side, no wonder we can't keep up with this pricing. We just can't keep up. You don't have the data to support the historical aspect of an appraisal because the market is moving so hard upward. We don't have the data to support it. So we're like low appraisal, low appraisal, low appraisal. That is happening right now too, as well. And so, but I think people are accepting of it because they put in, entire MLSs have put in additional paperwork saying, all right, if you have a low appraisal, here's the format. So we didn't even have that a few years ago. Didn't have that. We have it now because this is the way the market is, right? Shiller helped create the CME Standard & Poor Case-Shiller Home Price Index futures 15 years ago so people could hedge their risk during housing markets like this one. So our futures market is now predicting big increases over the next year or more, but it's not certain, he said. All right, I think the stock market is going to go to the moon, but I'm not certain. Doesn't it sound like that? I mean, isn't that how all professionals talk? Yeah, that's going to go down at some point in the next 18 years. How much it'll go down, I don't know, but I think it'll go down. Again, kind of like in the next 24 hours, I predict the sun will rise again. And it does. And the market will go down. It's just a matter of when. So what I'm talking about right now is, hey, I think we're in a little slowdown right now. I think you're going to see that. Maybe not. The beauty of having it recorded on a podcast is you can come back and say, yeah, that didn't really happen. That was just a little blip, and that's maybe where it is. But until we have enough data, I don't really know either. I'm just kind of telling you what I think, what I see. All right, here we are. And maybe it's just a few segmented markets that I'm looking at. But I really feel like we're at one of those points where you got to have a little bit of a slowdown. It kind of reminds me of the spirit that ended after World War II, Shiller said. Was he alive then? How old is he? I don't know. I need to do some research, clearly. There was a spending spree by people, but we all heard about that, right? After the war is over, it's just, oh, yeah, let's go. There was a spending spree by people. They were jubilant the war was over, he said, comparing the mood of the country then to the mood now as the United States emerges from coronavirus pandemic. Whew, we're emerging. We're coming out. All right, let's take a look at, so that was Robert Shiller, Case-Shiller index. The housing market is in a little bit of a bubble, Jamie Dimon says. Jamie Dimon, CEO of JPM Morgan Chase. Let's see what he's talking about. A little bit of a bubble. Not a big one, a little one. Okay, let's check it out. We've got CNN Business. Now, CNN Business, they wouldn't lie to us, would they? No. I don't think so. No. CNN Business, they cover their storylines they want to cover. I'm all right with it. And every now and then you pop off with one of these and it's like, okay, I'll read that. CNN regular? Yeah, probably not. But, you can get the same stories across multiple outlets and it's like, all right, I'll read that one. Sure, why not? I'll take a stab at that. Jamie Dimon acknowledged the housing boom may be getting out of hand, but the JPM Morgan Chase CEO isn't worried about a repeat of the Great Recession. But wait a minute. What did the headline say? The headline says, we're in a little bit of a bubble. All right, so what's going on? Dimon acknowledged during a Senate hearing on Wednesday that there is a little bit of a bubble in housing prices. But he added, unlike in 08 and 09, when there was tremendous leverage and bad mortgage underwriting. We're going to blame those bad mortgage underwriters. Those guys are bad. They're bad. They created that. Now, it was appraisers were to blame too. That's why we had this whole shifting of appraisal orders going to AMCs taking a chunk of the appraiser's fee. That literally is what happened. We didn't raise the appraisal fees at the onset. We took away. So say I was getting $400. Now I'm getting $200 for an appraisal. And half of that went to an AMC for doing the order out process. That was my reality. There are some good times. You want to have appraisers complain? Ask them about the fee structure in 08, 09. Ask them how that went. Not good. His comments, talking about Jamie Dimon's comments, came in response to a question from Senator John Tester asking if there is a housing bubble. Dimon was the only big bank CEO to outright say there is a bubble because nobody else has the guts to make any kind of predictions on anything, right? But he stressed the financial system is better positioned this time because banks have stocked up on loss-absorbing capital. Our capital runneth over. We have enough capital to withstand multiple crises, he said. All right. So remember back when all these banks we were talking about stress tests and can they withhold it? And we did stress tests and we did real live stress tests. And guess what? Too big to fail? Whew, they weren't too big to fail, were they? Washington Mutual, prime example of that. Countrywide, prime example of that. How'd that work out? It didn't. Just boom, done. Goldman Sachs CEO David Solomon said he doesn't see a bubble, though he urged the Federal Reserve to get the right balance in policy to keep booming asset prices in check. We don't want too much appreciation. We want some appreciation, but not enough. And that's where a lot of people are like, oh, inflation. Inflation going to get out of hand here? Are we really going to spend like $6 trillion to do all this stuff? What's that going to do for inflation? People are like, I don't know. I'm not sure if we're down with that. Got a lot of stuff coming up in the pipeline, right? Economic-wise, economy-wise. I think real estate-wise. Morgan Stanley CEO James Gorman said, while housing is not in a bubble nationally, some markets look very frothy. I think Seattle's one of those. I think realistically, if you look at a market that's done 19 and change in appreciation in a year, you got to have at least a little bit of a slowdown. Maybe you bring that back down to 15. And by bring that down, I mean happens. Okay. And I mean, get her down to 12, get her down to 8. Because anything above that, I mean, year after year at 8, that's not sustainable either. Because look at how quickly that doubles and then triples the price of a home. And guess what? That does not allow enough time for income to keep up. You've just basically got a bunch of rich people living there at that point, right? Which is, if you're rich, then hey, great. All right. Rich get richer, poor get poorer. But you're not going to have any people have the ability to live in these markets. They're going to be just far out, and it's just going to be this nightmare, which we're pretty much already at in a lot of these markets. That's where we're at. I mean, talk about affordable housing crisis. Yeah. Yep, for sure. So this has to be monitored very closely, Citigroup CEO Jane Fraser said. It's too soon to call whether it's a bubble or not. So we literally have got to get the right balance. We've got not in a bubble nationally, but some markets look very frothy. I could have said that. Maybe I should be CEO of Morgan Stanley. What a train wreck that would be. Yeah, no, we're not doing that. I'm going to go record a podcast. You guys figure it out. Don't care. Not a big issue. I think we'll be okay. Let's just go. Shareholders, they're overrated. Let's just, I got to go to the gym. You guys figure this out. That's how my CEO would go. That literally is how my CEO goes of a couple of small companies. So this has to be monitored very closely. We got to keep an eye on it. It's too soon to call whether it's a bubble or not. Those are statements by CEOs who they're not really in the day-to-day game, are they? No, they're so elevated out of the system, out of the day-to-day that they have no idea. They're looking at some stats going, all right, but I haven't closed a deal in ever, but I did write a book. I wrote a book one time. People ask me, hey, you should write a book. And I'm kind of like, about what? What would I write a book about? I do mini books every single day. I do like 3 of them, 3 podcasts a day. Is that not good enough? No, we need you to have a hardback book. Probably not. Again, I'm going to go do something else that I enjoy. Writing a book, probably not one of them. All right. Unless somebody paid me a crap ton of money, and then you would have my attention. How much is a crap ton? I don't know. Make me an offer. No, I think, you get to be a CEO of a major publicly traded company, and you are working on so many other things that the day-to-day of what a real estate market is actually doing, that is not within the scope of what you cover. That's just not a thing. It's just not. So then when you've got these guys making these statements, of course they're going to hedge their bets. They're garden beds. They're going to hedge their garden beds all day long. That should be a new term to go along with. It's too soon to call whether it's a bubble or not. But I think we're in a little bit of a slowdown right now. That's just me. What would I know? I'm a real estate broker, managing broker, owner, and an appraiser. That's, by trade, that's where I'm at. But I think we're going to keep an eye on it. And as these trends continue, as more data comes out, I'm going to read it for you right here in the Seattle Real Estate Podcast. All right. So how was that for a wishy-washy podcast? What did we learn? Sean thinks the real estate market may or may not be in a little bit of a slowdown. Don't really know. Have to see. Does summer come along? Because summer really hasn't started here in Seattle. It hasn't. I mean, it was raining this morning, kind of cold. July 5th, that's when our summer starts. So I'll catch up with you July 5th, let you know how the real estate market's going. That's not that far away, is it? Like 5 weeks. Crazy. It's summertime. Okay. Thanks for being here. Thanks for being part of the Seattle Real Estate Podcast. I've got some other stuff to cover, but hey, I did a real estate podcast. 2 thumbs up for Sean. Participation ribbon. All right. We'll see you guys later. Thanks for being here. Stay safe. We'll talk soon. Bye. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.